The volatility we saw in the first quarter, the daily headlines that investors had to absorb, this was very unnerving, and we understand that. But it's important to remember that coming into this year, valuations for equities were so expensive that even some of the areas that saw corrections, like the NASDAQ, like growth stocks, like some of the European indices, even with a 10% drop, you didn't see valuations get to levels that looked extremely compelling. You were still looking at these markets trading at premiums to their historical average. Now, when we look at things like capitulation, we talk about capitulation as signs that the market's washed out and it's a good time where everybody's running out the door to run in. We never really saw that either. Investors would see a day that it was down 2% just to come in the next day to see it back up 2%. So it was a lot for investors to absorb, but we're focusing on that fundamental and valuation story. When you look at some of the things like, for example, the S&P 500 in this chart, when we talk about a washout, you look at the price to earnings multiple, above the red line is a premium, below the red line is a discount. Not once did it go into the discount territory where we think it's a really good time to go in as a contrarian. In fact, it didn't even go as low as it did during Liberation Day. Also, when we look at the changing fundamental landscape, just at least for the short term, we're talking about higher inflation, higher interest rates, and some concern about economic growth in the near term. None of these things were really around coming into this year. But when you look at this chart, analysts aren't changing their view from an earnings perspective. There's been no adjustment at all. In fact, since February, we've seen analysts upgrading their earnings estimates. So something doesn't make sense to us here. We've got valuations just right back to as expensive as they were. We don't have any adjustment to earnings, and we have concern about not only inflation and the economic environment. So here's what we would do for your exposure. If you don't have any small and mid-cap exposure, that's the area we still like because that now is trading at a slight discount. There could be some volatility in the near term with interest rates because they are interest rate sensitive, but long term, it's a good opportunity. International stocks, they had a great run up, but they've been hit in this recent volatility. They're still trading at a slight premium, but there's plenty of room to catch up to the U.S. market because they're still at a historical discount to U.S. equities. Hold off on U.S. large cap, trading at double-digit premiums right now from a valuation perspective, and earnings that aren't factoring in any of these risks. Now, we'll sit with the dry powder that we have, we'll be patient, and we will look for opportunities when those fundamentals and valuations align.